Virus forcing companies to slash dividends, says Goldman Sachs. They expect the S&P 500 dividends to fall by 25%. And this is huge news on the positive side. Huge news on the positive side. So let's read this. I have no idea if Goldman Sachs will be right or wrong. I don't know, but Goldman Sachs was predicting a Q2 GDP decline of 24%, which was pretty phenomenal. I've never seen that before. And if they are right in both of these, this is huge buying opportunity. No other way around that. All right, and I'll show you why. Let's read this. The economic slowdown by the commie virus will result in a sharp drop of dividends paid by the S&P 500. The firm sees dividends falling by 25% to $44 per share in 2020, which is 25% their 2019 level. The recently passed CARES Act stipulates that any companies that borrow money from the federal government may not repurchase stock, pay a dividend, or make any other capital, financial, or cash distributions until at least a year after the loan has been repaid, says some guy from Goldman Sachs. All right, so check this out. All right, so that's interesting. So what is the S&P 500 right now dividend yield? Well, let's take a gander, shall we? We'll look at the total stock. Just use that. So the total stock market index, the dividend yield. The dividend. Can I close this guy? 1 second. All right, there we go. The dividend yield right now is 2.72 on the S&P 500. 2.72. All right. So that's on the total stock index. So if that is reduced by 25%. What do we say here? Do you say 25%? Yeah, 2.72 on current price. So 2.72 minus 25%, that means it's 2.04. That's on the total stock index, 2.04% on the total stock of a 25% decline in dividend yield. That's on the price as it is today. That's not nearly as bad as I would have anticipated. And let's keep reading. Right here, the economic slowdown caused by the pandemic will slash S&P 500 earnings by 33%. I want to hold that. I want to come back to that because there's huge benefit there. Such a drop would normally result in dividends falling by 11%, but certain large dividend industries are particularly vulnerable to the economic shock, as well as the collapse in crude oil prices. So if we get out of this with a 25% decline in dividends, which still puts the total stock market index at above 2% on price as of right now. Let's see, hold on, 126.78. Yeah, so right now it's trading at 126.78 with the market just having opened. That's still pretty good. That's not nearly to the extent. That's not what happened in 2008. All right, so now the PE ratio on the total stock index is 10. All right, so if we get a 33% decline in earnings, so what we do is we take our 10 and we divide that by, we'll be precise, 10.60. We divide that by 0.6. We'll just do 0.67. That still puts us at a PE ratio of 15.82 as we decline in earnings by 33%. So what we're doing is we're saying if they made $100 of earnings last year, they were going to make $67 of earnings this year. Take the projected earnings, divide by the current price, that still puts us as a PE ratio of 15.8, which is historically right in average where it should be. That's fantastic. All right, so let's look at VTV to give you even better. VTV, which is value stocks. They got a PE ratio of 8.83. So we're going to say 8.83. And you can't really extrapolate the whole S&P 500 into the total stock index because there's about 30% of that is in mid cap and small. You can't really extrapolate the whole S&P 500 into the value stock, but we're just going to do it for giggles here. There's some value to doing this to get a gauge of that they're good. The market could have overpriced the decline. But let's see. I mean, I'm just going off what Goldman Sachs says. I mean, it's just modeling. I have no clue. I don't trust models. But given that Goldman Sachs was saying initially that a 24% GDP collapse, and now we're going to sit there on a less than 16 PE ratio with still a 2% dividend yield. That's pretty attractive to me. I guess on my eye. All right, so now the value Vanguard Value Index is 8.83 is the PE. We're going to divide that by 0.67. So now we're at 13.17 PE on the value index, a dividend yield of 4.27. And we're going to slash that. We're going to minus that by 20. What do you say? 25%. Still puts us at 3.2. There's some serious. I'm telling you, man. Let's keep that's huge. That's huge. That's huge. The economic slowdown caused by the pandemic will slash earnings by 33%. We're going to talk about that. He added that the record high level of net leverage for the S&P 500 stock, coupled with ongoing credit market stress, makes it unlikely firms will borrow to save their dividends, which we don't want them to borrow to save their dividends. That's always stupid. I mean, the reason they do that is because you have a tax write-off on interest and you don't have a tax write-off on dividends. It's double taxation on dividends. The corporations pay the taxes when they earn the money in which to pay the dividends, and you, as the recipient of the dividends, pay taxes on the same dividends for which the corporation already paid tax on. It's nuts. So it rewards debt and it punishes dividends. It's stupid. It's one of the biggest freaking issues in finance that there is, a double taxation of dividends and the recognition that you can write off interest loan on your debt. Dumb. All right, so already there have been 12 companies that cut. Already there have been 12 S&P 500 companies that have cut or suspended their dividends, and that number is expected to increase as earnings seasons gets underway next week. Others, like Chevron, have taken action to conserve cash in an attempt to save their dividend. The energy giant last week joined rivals Shell in slashing capital expenditures by 20% and halting share buybacks. We've been in these circumstances before, said the CEO. We know what actions to take, and we're taking them. While the short-term outlook looks bleak, the guy from Goldman Sachs says dividend growth looks solid over the long run. We expect S&P 500 dividend per share will grow by an average of 3.6% through 2029. All right, my friends. Look, I don't trust Goldman Sachs as far as I could kick them, but I don't know how you can take anything of that other than positive. That's fantastic. That's fantastic. Maybe the overreaction presents a buying opportunity. Anyway, all right. So put that in your pipe and smoke it and say, we can come back to this later on and say, this was good news. So, I mean, again, the market is always forward looking. So to think that the market hasn't already priced a collapse in earnings and dividends into this, and now we actually see some raw number. In fact, let me read you something from right here. My most recent Nick Murray newsletter talk about Jim Paulson right here. Here's Jim Paulson. Although the contemporary crisis is loaded with bad news, this has not been his primary problem. It's the unknown. Give me bad news any day over complete uncertainty. Now that we got some certainty, with some thought, and we'll get more next week. Stay tuned. All right, we'll see you.